Hi everyone, before I start this video, make sure that you're a part of my Discord server. The link is in the description box below. And in this video, we'll be going over A-Level Accounting 2023, October-November, Paper 2-1, question number 1. This is the paper 2, which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit given for this paper is 1 hour and 45 minutes. Since question number 1 is of 30 marks, ideally you should be spending about 35 minutes in order to solve this question. And in this video as well, we'll be attempting to solve this question under 35 minutes. So without any further delay, let's get started. Leila, a retailer, did not maintain a full set of accounting records for her business. She has provided the following information for the year ended 30 September 2023. So this is our year end, the closing date. Then we have been given the balances at 1st October 2022, which means that all of these are our opening balances. We have the opening balance for inventory, non-current assets at carrying value, other payables, which is the light and heat, other receivables, which is the insurance, and we have trade payables and trade receivables. We also have the summary of bank account for the year ended 30 September 2023. And whenever we're talking about bank account, our debit side will represent all of our receipts or income, and our credit side will represent all of our payments or expenses. Okay, then the following information is also available at 30 September 2023. This is again at the closing date. Leila has started to prepare her financial statements for the year ended 30 September 2023. The following figures are available to transfer to the statement of profit or loss with no adjustments. So this just means that these are the values which have been adjusted already. So if you are talking about insurance, this amount of 2,720, we arrived at this amount by starting from the payment made for insurance, which is 2,560, and after making adjustment for its prepayment and accruals. And in this case, we have at the opening date, we have other receivables, which means that this was a prepayment at the opening date, and the opening prepayment is always added. So we need to add 480. Then we made the closing date adjustment as well. But in this case, we have not been given the closing date adjustment. So let's try and figure that out. This is a closing date adjustment. And remember, for our closing date, if this is an outstanding amount, we add it. So any added or positive amount will represent our accrual. And if it's a negative amount, it will represent prepayment because we subtract the closing prepayment values. And this will give the value of 2,720. Now, our closing date value for our insurance is just going to be 2,720 minus 2,560 minus 480, which gives the amount of negative 320. Since this is a negative amount, this 320 will represent our closing date insurance prepayment. Okay, now we repeat the same process for light and heat as well. In order to arrive at this value of 3,880, we first have to start with the payment made for light and heat, which is of 3,510. So that's 3,510. Then we make adjustment for our opening and closing balances. In this case, for light and heat, we have the other payables at the opening date. So other payables just means that this amount of 210 was outstanding at our opening date. And the opening outstanding values are always subtracted. So let's subtract this value of 210. Then we are trying to figure out our closing balance. And this will give the amount of 3,880. Again, the rule is same. If our closing balance is a positive amount, then it will represent our closing accrual or closing outstanding amount. If the closing balance is negative, then it will represent a prepayment amount. In this case, our closing balance is just going to be 3,880 minus 3,510 plus 210. This gives the amount of positive 580. Since this is a positive amount, this amount is going to represent our light and heat outstanding at the closing date. So we are yet to pay this amount of 580 at our date of 30 September 2023. Then we have the loss on disposal of non-current asset. And remember that loss on disposal occurs when our net book value is higher than the sale proceeds. So in this case, the loss will be equal to net book value minus sales proceeds. And we can look at the sales proceeds within our receipt section of the summary of bank account. Right here, we can see that by making the sale of non-current assets, we received 860. This will be our sale proceeds. Now we can just substitute these values within the equation. So our loss is 120. We're trying to figure out the net book value, and the sale proceeds is given to be 860. This means that our net book value is just going to be 120 plus 860, which results in an amount of 980. That's the net book value of the disposed non-current asset. Then all sales are made at a markup of 25%. So this just means that in order to get our value of sales, we can multiply our cost by 1 plus 25%. We're just increasing the cost by 25% in order to arrive at the sales value. Then all sales and purchases are made on credit. Okay, so whenever we have the sales and purchases on credit, we need to figure out the credit sales or credit purchases, starting with the amount that we have received for the sales or the amount that we have paid for the credit purchases. Then we need to subtract the opening trade receivables and the opening trade payables and add back the closing trade receivables and closing trade payables. Then the balance of trade receivables at 30 September 2023 was given to be 3,650. So this means that we can easily figure out the value of credit sales. Like I said before, we first start with the receipts for our credit sales. Then we subtract the opening balance of trade payables, add back the closing balance of trade payables. Alright. In this case, we have the receipts from trade receivables to be 55,390. So we start with 55,390. We were given the opening balance of trade receivables as well. Right here, the amount is 4,540. So we subtract 4,540. Then we add back our closing trade receivables, which is given to be 3,650. And this gives the amount of our credit sales to be 54,500. And remember, we also told that all sales are made on credit, which means that this is our total revenue. Okay, but we cannot figure out the same for purchases, because in this case, although we have the payments made towards trade payables as well as the opening trade payables balance, we are not given the closing trade payables balance, so we cannot implement the same formula for purchases. And in this case, since we are given the equation right here, we can figure out the total of the cost of sales by implementing this equation. Then I think we can figure out the value for purchases, because we have the opening inventory right here of 12,030. Then I think we've been also given the information for closing inventory, and after that we can just figure out the value of purchases. Then there were no additions to non-current assets during the year. This just means that there had been no additional purchases of non-current assets. All non-current assets are to be depreciated at 10% per annum using the reducing balance method. Okay, let's figure out the depreciation on non-current assets. Since this is based on the reducing balance method, we need to start with our net book value. And in this case, there was also a disposal of non-current asset. Remember that we cannot apply depreciation on the disposed assets, which means that we first need to subtract the net book value of the disposed asset from the total net book value at the opening date. Then we can multiply it by the rate of 10% in order to calculate the depreciation charge for the year. Okay, let's start with the opening net book value. For our non-current asset right here, it's given at its carrying value, which is the net book value. So we have 22,180. Then we need to subtract the net book value of the disposed non-current asset, which we have already figured out to be 980. Then we need to multiply it by the rate of 10%. And this gives the depreciation charge on our non-current asset to have the value of 2,120. Okay. Then Leila was unable to physically count the inventory at 30 September 2023, which is our closing inventory. The inventory was valued at 14,400 on 1st October 2023. Okay, so remember that 1st October is right here, which will be our closing date of 30 September 2023. Then we have 4 October 2023. So at this date, our closing inventory is of 14,400. We're trying to figure out the closing inventory at this date of 30 September 2023. Now, the changes within our closing inventory of 30 September 2023 is just going to be any sales made, because any sales made is going to reduce our inventory, which means that from the closing inventory of 30 September 2023, if we subtract the sales made, and remember, we should subtract the corresponding cost of the goods sold, not the actual sales value, because the closing inventory is only valued at cost. And any new purchases made will be added to our closing inventory, because those purchased goods are yet to be sold, right? So we need to add our purchases to the closing inventory at 30 September 2023, and that will give the closing value of our inventory at 4th October 2023. Okay. Then for the first part, we need to calculate the value of the closing inventory at 30 September 2023. Okay. So again, we implement this same equation. So we're trying to figure out the closing inventory. If we subtract the cost of the goods sold, we can get the value of inventory at 4th October 2023. And in this case, we are told that between 1st October 2023 and 4th October 2023, sales were of 3,400. But again, remember that we can only include the cost of the sales. So in order to calculate the cost, we can again use our markup. Because markup was of 25%, our sales value is just going to be cost times 1 plus 25%. We already have the sales value of 3,400. We're trying to figure out the corresponding cost, and 1 plus 25% can be written down as 1.25. So this means that the corresponding cost is just going to be 3,400 divided by 1.25, which results in the cost of 2,720. So we need to subtract this value. Then we need to add any purchases made between this date. And the purchases made is given to be of 1,850. So let's add that. And this will give the closing inventory at 4th October 2023, which is of 14,400. So this just means that our required closing inventory is of 14,400 plus 2,720 minus 1,850, which means that the value for the closing inventory at 30 September 2023 is just going to be 15,270. That's all for the first part. Let's move towards the second one. We need to now prepare the statement of profit or loss for the year ended 30 September 2023, and we need to use the space provided on page 4 to show our workings, but I've already showed all of my workings within the question paper itself, so you can refer to that in order to get the workings required for the boxes given below. Okay, since this is a statement of profit or loss, we can first start with the revenue, and we've already calculated the revenue by calculating the total of our credit sales, and that was of 54,500. Then the next step is to subtract our cost of sales, and the items included within the cost of sales will be our opening inventory. Then we have to add the purchases, and in this case we did not figure out the purchases because we were not given the value of our closing trade payables, which means that we first need to calculate the value of cost of sales using our markup formula and then figure out the value for purchases. After purchases, we need to subtract the closing inventory. Okay, let's write down the value for closing inventory. We just calculated it to be 15,270. Then the opening inventory was given to be 12,030. Now we need to calculate the purchases, and in order to do so, we first need to calculate our cost of sales. Again, the formula is that sales will be equal to cost times 1 plus 25%. In this case, we have our total revenue of 54,500. If we bring this to the other side, that will be divided by 1.25. This will be equal to the cost, or the cost of sales in this case. So the value of our cost of sales is just going to be 43,600. So 43,600 right here. And remember that 43,600 is the sum of these three items. So again, we can create another equation. We have 12,030. We add purchases, subtract our closing inventory of 15,270 and get the value of 43,600. Now the purchases value is just going to be 43,600 minus 12,030 plus 15,270. This gives the total purchases to be of 46,840. Okay, now again, remember that in order to get our purchases, we were also told that all of the purchases are made on credit. So our credit purchases is just going to be the payments minus the opening balance of our trade payables plus the closing balance of trade payables. And in this case, since we are not given the closing balance, we can now figure it out. So the total of our credit purchases is 46,840. The payments made for trade payables was 46,280. So 46,280. Then we need to subtract the opening balance of trade payables, which was of 3,840. And now we can calculate the closing balance of trade payables. So closing balance of trade payables is just going to be 46,840 minus 46,280 plus 3,840, which gives the value of 4,400. That's our closing balance of trade payables. Okay, now we can move towards calculating our gross profit. And gross profit, we just need to subtract 43,600 from 54,500, which gives a value of 10,900. Now we need to add any other incomes, but in this case, there are no other incomes, so we can move towards our overheads. So minus overheads. And we have been given the values to be included within our overheads right here. So we have insurance of 2,720, light and heat of 3,880, and loss on disposal of non-current asset of 120. And on top of that, we also calculated depreciation of 2,120. That will also be our overhead. And yeah, that will be all for the overheads. Let's write down those 4 items. We can start with our insurance with the given value of 2,720. Then we're also given the light and heat. That was 3,880. Then we were given the loss on disposal, which was of 120. And we calculated the depreciation charge, which was of 2,120. Now let's calculate the total for our overhead by adding these 4 values. So that's 2,720 plus 3,880 plus 120 plus 2,120, which results in 8,840. Now we need to subtract this overhead from our gross profit in order to get the profit for the year. So the profit for the year is just going to be 10,900 minus 8,840, which results in 2,060. That completes the statement of profit or loss. Okay, and again, you need to show all of your workings for your purchases, workings for your depreciation, and the working for your revenue within the given box for the workings in order to get your markings correctly. Now we need to prepare the statement of financial position at 30 September 2023. Again, the items for which you need to show your workings are given below. And remember, we have already calculated the other receivables and other payables, because these are just the closing outstanding values and the closing prepayment values. And for our light and heat, we figured out that 580 will be outstanding, which means that we are yet to pay this amount. So this 580 will be a part of our other payables. So other payables is just going to be a 580, which is the light and heat outstanding amount at our closing date. And for our other receivables, we have already calculated that there was an insurance prepayment of 320. So we have already paid this amount of 320, but we are yet to receive the services for it, which will make this other receivable. So our other receivables is just going to be of 320, which is from the insurance prepayment. Okay, and we also calculated the trade payables. So the closing balance of trade payables, we calculated it right here. That is just going to be 4,400. So that will be 4,400. Then we have our equity at 1st October 2022. Okay, we are yet to calculate it. Let's prepare the statement of financial position. We can just start with our non-current assets. And remember, for non-current assets, we have to include it at its carrying value, right? So I will just prepare the schedule of non-current assets right here. So what you do is you start with the opening balance of at the net book value of your non-current asset. Then you add any purchases. And these purchases will be added at its cost. But in this case, we are clearly told that there were no additions, so there will be no purchases. Then you need to subtract your disposals. And disposals will also have to be at the net book value. Then you need to subtract the depreciation charge for the year. That way you will get the closing balance of net book value. And within the statement of financial position, you always need to include the closing balance. So let's start with the opening balance. The opening balance of our non-current asset was of 22,180. So 22,180. Then there were no purchases, so that will be 0. For disposals, we've already calculated the net book value. The net book value of the disposed non-current asset was 980, and the depreciation charge for the year was of 2,120. So we need to subtract the 980 as well as the depreciation charge of 2,120, and this will give the closing balance of our non-current assets at its net book value to be 19,080. So this is the value at which we need to show our non-current assets within the statement of financial position. Let's write it down. So that will be 19,080. That completes our non-current assets section. Then we can move towards the current assets section. Okay, so our current assets will include the closing inventory at 15,270. Then we are also given the closing trade receivables of 3,650. And what else do we have? And we've also calculated the other receivables, which was of 320 due to insurance prepayment. So those three items will be a part of our current assets. So we first have our closing inventory, whose value we calculated to be 15,270. Then we were given the closing trade receivables. So the closing trade receivables was of 3,650, and we've calculated the other receivables, which was of 320. Let's calculate the total for our current assets. That will be 15,270 plus 3,650 plus 320, which is also 19,240. Now we can calculate our total assets. For total assets, we just need to add the total of our non-current assets and total of our current assets. So that will be 19,080 plus 19,240, which results in 38,320. This completes the first section. Now we can move towards the equity section. Okay, within equity, this is of a sole trader, right? The sole trader is Leila, which means that our equity section is just going to be the starting balance of our equity. Then we need to add the profit for the year and subtract any drawings, since we are concerned with the sole trader. Okay, but in this case, we're not given the opening balance of our equity. That is why we were given the working section for the calculation of equity at the opening date. So we need to calculate the equity at opening date, and we can do so by utilizing the balances at our opening date. So we can categorize these as either assets or liabilities. So inventory is our asset, non-current asset, again an asset. Other payables is our liability, other receivables is our asset, trade payables liability, trade receivables are assets. And we can just utilize our accounting equation, which means that asset will be equal to capital plus liabilities. And capital is just going to be our equity. So equity is just going to be asset minus liabilities. Let's do that. So first asset we have is of inventory, 12,030. Then we have our non-current asset of 22,180. Then we have liability of 210. We need to subtract it. We have an asset of 480. We have another liability of 3,840, and we have another asset of 4,540. And also remember that we have our bank account right here. And bank will be an asset if its opening balance is on the debit side. If its opening balance is on the credit side, that will just represent a negative bank balance. In this case, since we have the opening balance on the credit side, this represents a negative bank balance, which means that this will be our liability. So we need to subtract this amount of 1,220 as well. This will give the equity at the opening date to have the value of 33,960. You need to show this workings within the given box so that you get your markings correctly, and the equity is of 33,960. Let's write it down. So the opening balance is of 33,960, and the adjustment is that we add our profit for the year and we subtract any drawings. Okay, we've calculated the profit for the year to be 2,060. Let's add it. Then the drawings were given within the summary of bank statements. The drawings was of 3,850. Let's subtract it. Then we can get the equity at our closing date. So that will be the sum of these three items, 33,960 plus 2,060 minus 3,850, which results in 32,170. That's the total equity. Now we can move towards our non-current liabilities, but in this case, I don't think we were given information regarding any non-current liabilities. Yeah, so we only have the current liabilities, which will include our light and heat outstanding. So that will be other payables of 580. Then we have calculated our closing balance of trade payables of 4,400. And let's see, for our bank, we have the opening balance again at the credit side. So this will also represent our current liability. So we need to include this under the heading of bank overdraft. Those three items will be a part of our current liabilities. So the first one is our trade payables, which we calculated to be 4,400. Then we have other payables, which we calculated to be of 580. Then we also have bank overdraft, which was of 1,170. Okay, let's add it all. That will be 4,400 plus 1,170 plus 580, which results in 6,150. Now we can calculate the total equity and liabilities. That is just going to be 32,170 plus 6,150, which results in 38,320. And we can see that our total assets is equal to total equity and liabilities, which means that our statement of financial position is correct. Okay, that's all for this part. Leila wishes to expand the business and is considering forming a partnership with her friend. State 4 provisions of the Partnership Act 1890 that would apply in the absence of partnership agreement. So always remember that in the absence of partnership agreement, the profits and losses will be shared equally. No interest will be charged on drawings. No interest is allowed on any sort of capital. And any partner's loans will get an interest of 5%. So let's write down these 4 provisions. The first one is that the profits and losses are shared equally. Then there will be no interest is charged on drawings. Similarly, no interest is charged on capital. Then interest of 5% is allowed on partner's loan. That's all for the fourth part. Now for the fifth one, we need to say 3 possible disadvantages to a business of maintaining a full set of accounting records. So the very first disadvantage is that maintaining a full set of accounting records will increase our cost, which might result in decrement in our profits. So there may be an increase in costs, which results in decrease in profits. Then sometimes the business owner might lack the expertise as well as the skills required in order to maintain a full set of accounting records. So that will also be a disadvantage. The business owner might lack the expertise or skills required to maintain a full set of accounting records. And since the owner might not have the skills required to maintain a full set of accounting records, they might have to employ someone else in order to maintain the records. That will also be a disadvantage. The owner may have to employ someone else to maintain the records. This completes the first part of this question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.